Let's have a quick look at closing prices for the Zimbabwe Stock Exchange, African currencies, commodities, metal and energy prices in Africa and around the world. In our main story, the Central Africa Building Society, CABS, says it will close down 4 additional branches as operational challenges triggered by the obtaining harsh economic environment take a toll. In a letter written to clients, CABS Managing Director Simon Hammond revealed details of the pending closures, which are likely to leave more employees jobless. Please be advised, and in line with our branch rationalization strategy, the following branches will be closing on the 31st of January 2020. Highfield, High Glen, Letombo and Norton. All services will be available at the nearest branches or any other CABS branch nationwide, Hammond said in a letter. The move comes after CABS closed down 4 other branches in Harare. That's in Mount Pleasant. In Bulawayo, they also closed down in Kulumane, Mutare, Dangamvura and CA House at the end of October 2019. Zimbabwe Banks and Allied Workers Union General Secretary Shepherd Ngandu said he was deeply disturbed by the continuous job cuts. We are disturbed by these developments in the financial services sector as banks continue to close branches, particularly those multinationals like CABS and Standard Chartered Bank, he said. The Mint spoke to Tawanda Mutemi, president of the Zimbabwe Bankers Union, on the impact of branch closures on workers.
A serious downsizing by many banks over the past several months. Of late, I'm sure if you have been following the story, CABS is closing 4 branches, and it is true that it is affecting us as bank employees. CBZ rationalized a few months ago. First Capital Bank sent home 120 employees, and there is a possibility that more retrenchment may be coming. The reason why we think that the banks are downgrading are basically two. Firstly, is the economic situation. The banks are also trying to cut costs. And secondly, it's because of the new technologies which they are adopting, and these automatic systems which do not require intervention. So from our standpoint, these are the 2 main causes, but the critical one is the economic situation. From where we stand, things will only get worse, especially for the public, because if you look at a bank like CABS and the kind of branches which they are closing, it means that the public is going to be seriously affected, not only us as employees, but those who want to access banking services will be seriously affected, especially if you consider that some of these branches are located in rural areas or semi-urban areas where they've been serving communities. Yes, banks argue that they are moving on to new platforms, but it's not everyone who is keen to go onto these platforms, and it's not everyone who can access these platforms, because one requires internet. So the conventional banking is still required as a form of public service to the population.
Indications across the wider financial services sector have shown that banks are rolling out aggressive investments towards upgrading their digital platforms, as well as enhancing their information communication technologies to process more transactions and launch more customer-centric products. As a result, in reverse of tradition where banks' incomes were largely driven by loans and advances, most banks in Zimbabwe have seen their net incomes largely driven by non-interest income, which is facilitated through electronic transactions, which have increased as a result of the ongoing cash shortages. The Johannesburg Stock Exchange, JSE, has partnered with the African Development Bank, 6 strong African exchanges, and the African Securities Exchange Association to strengthen investments into Africa. The collaboration comes to foster cross-border trading and settlement of securities across African countries' exchanges. Further, the initiative go after unlocking the Pan-African investment potentials while attending to various drawbacks, such as the inadequate depth and liquidity in Africa financial markets. According to a report by Quartz Africa, foreign direct investment, FDI, is expected to have risen by 20% in 2018 to $50 billion, after falling in 2017 by 21% to $42 billion. According to the African Development Bank, the 7 stock exchanges participating in the first phase of the AELP represent about 85% of Africa's securities market capitalization. The JSE is based in Johannesburg, South Africa, where it has operated as a marketplace for the trading of financial products for 132 years. It connects buyers and sellers in equity, derivative, and debt markets. The Johannesburg Stock Exchange is one of the top 20 exchanges in the world in terms of market capitalization and is a member of the World Federation of Exchanges. Despite Africa's diverse financial landscape, it is still potential for the continent of 1.2 billion people to take a giant step into bolstering its investment line. According to AFDB, the AELP kicked off in 2016 with only 4 exchanges and has grown to 7 participating exchanges. The participating exchanges are the JSE, the Egyptian Exchange, Stock Exchange of Mauritius, the Casablanca Stock Exchange, Nairobi Securities Exchange, the Nigerian Stock Exchange, and Bourse Regionale des Valeurs Mobilières, which serves Francophone West Africa. However, the main goal is for all 27 African stock exchanges to join the project and increase Africa's competitive advantage compared to other emerging markets. Further, per the AFDB press release, the AELP has aligned its goals to include the creation of a central trading platform linked to exchange trading systems, the free flow of trading information between linked exchanges, broker access to a linked trading platform, and the creation of products based on securities from all the allied exchanges. According to the New York Times, Kenya's new Chinese-built railway should have been a boon for business in Kenya. The $3.3 billion line sliced hours off the journey from the port city of Mombasa to the capital, Nairobi. But some importers said their transport costs shot up by nearly 50% when they used the rail due to extra fees, more time spent clearing goods at the congested Nairobi train depot, and the need to send a truck to collect the goods from there. These importers used to truck their goods in from the coast, but port authorities now say businesses based in Nairobi and upcountry must use the new line because the Mombasa port is contracted to supply it with a minimum amount of cargo. The railway's problems are a cautionary tale, both for developing nations loading themselves with Chinese debt and for China as it seeks to expand global trade links and project soft power through its massive Belt and Road initiative. China has sought to allay fears that its infrastructure projects overload some countries with debt. Last year, it agreed to restructure more than $12 billion in repayments owed by Ethiopia, whose Chinese-funded railway is also struggling. Now some Kenyan politicians are asking whether their railway was worth the cost. The contract between China's Exim Bank, the Kenya Ports Authority, and Kenya Railways requires KPA to provide 1 million tons of cargo to the railway per year, rising to 6 million by 2024. KPA says rail cargo is expected to hit 5 million tons this year after more than 4 million tons last year. Mombasa is projected to handle 34 million tons of cargo this year. Most goes by rail. Cargo destined for Mombasa or countries other than Kenya can still go by road. But Kenyan importers in and around Nairobi say they have been forced to use the line since October last year and so pay the higher fees. The China Road and Bridge Corporation, which built the railway and now runs it through its Kenya subsidiary Africa Star Operations, said it did not set policy on cargo. The exact terms of the agreement are not public. The new line opened in 2017, running alongside the dilapidated track British colonialists built a century ago. It cut the Nairobi-Mombasa journey to 4 hours from 12 hours for passengers and to 8 hours from 24 hours for cargo. Well, I'm Andy Hodges, and you've been watching The Mint. Please follow us on our Facebook page, Zim Papers TV Network, our website, ztn.co.zw, and YouTube under ZTN. Your comments, of course, are welcome via our Twitter handle at ZTN News and Facebook. Join us here on The Mint every weekday morning at 6 a.m. Central African Time. Well, that's it. Goodbye. Have a profitable business day, and you all be safe.